Okay, here's another weekly episode of Rental House versus High Income ETFs, episode 7.3. And if you're new to this channel, we sold our rental properties. The last house we sold, we took that money, put into a couple cover call ETFs. And this is an experiment to see how that investment would do as if we had kept the house. If you're new or old, I'd appreciate it if you subscribe. So what happened this week? We are sitting at 66,000. Here's our margin that we're using. I'm using margin on this Robinhood account. Here's what I got invested in each of the different funds: 500 giax, 200 SPYI, 600 aipi, 2,700 in qdte. I did buy some more SPYI. We'll talk about that in a second. Here's an overall look at what's going on in the market. Here is SPY, S&P 500. The 20-day moving average is starting to level out a little bit. The price is coming down to the 20-day moving average. The price is in the middle of the Bollinger Band. The RSI, Relative Strength Index, is about 56. It was getting high. So here last week, I was expecting right in here somewhere, based on the Bollinger Band and the RSI, I was expecting a little bit of a sell-off, which did happen. So right now this week, I'm assuming things may continue going sideways a little bit, maybe up a little bit. Now there is news about this new tax bill coming out. I don't know what that's going to do with the market. So I mentioned I did buy some more SPYI, bought 50 shares at $49.58. So not a bargain price, but I still want to keep adding to my positions here. And SPYI is what I've been buying lately. So last week we got a distribution from qdte of 464. We got a distribution for SPYI of $100. And we bought $2,479 worth of SPYI, 50 shares at $49.58. And the distributions for qdte have been down for the last couple weeks. Here you got 464, week before 484. And down here we had 830. A few YouTubers I follow, they give estimates of what qdte is going to do in the future, and it's expected to jump back up around the $600 distribution for next week. So expect that to go up a little bit. Okay, here's another look at the activity, the distributions. This is margin and distributions that I have going on. And this is here last week. And monthly totals, you go back to November. November was good. December was really good. January was about 4,000. February, 3,200. March, 3,000. April, almost 3,000. So we have a distribution coming from aipi, giax, qdte. So I expect this to be about 3,800. So we have an extra week here, extra Friday. So qdte will pay out 5 times this month. And I tossed this in to get an idea, like what is the average annual return? So this is as of a couple of days ago. So this is what I got, the 2,700, 600, 200, 500. This is the current prices. This is the average cost. And so the equity with the margin is 136 about. And these are the rates of return for each one individually. So qdte, aipi both are like 35%. SPYI is about 12%. giax is around 24%. And so if you do the math, this is the monthly distribution. And so about the average rate of return is about 33% when you take this annual distribution and divide it by the equity, it comes out about 33%. People might look at this, two types of people look at this and say 12% for SPYI. They might be saying, why are you buying SPYI at 12% when I could buy more aipi or any of these other three and get a higher rate of return? And it's basically because of the net asset value. The SPYI keeps the NAV better than the others so far since they've been released. So all these funds are pretty new. SPYI has been around for a few years, has a track record. So at this point, I'm going to keep adding SPYI until I get a better idea of how the rest of them are going to handle the NAV, the net asset value. We'll wait and see. I could go either way. I could just say I'm going to buy some more aipi at 35% rate of return. Even if the NAV does go down, the total rate of return could still be higher than the 12%. But we'll wait and see. I don't know yet. That's why I'm doing this, to see what happens. I could be doing this with paper trading for a year, but then paper trading gets boring. You don't really have any skin in the game. The money from this is not money that I am relying on for retirement or anything. It is money. Don't get me wrong, it's quite a bit of money, but it's money that I'll probably use for travel or give my kids someday. Who knows? So my kids might get nothing, or they might get millions. Who knows? But while dad sits there and plays around with the stock market, they're probably sweating, wondering what the hell I'm doing. So anyhow, let's keep moving on. How are things going? So when I start this journey, I projected how things would go, and this is the projected stuff over here. And over here is actually how's it going. So anyhow, I projected I'd be sitting at 87,000 right now and 153,000 total invested, and I'd be up like 25% from the beginning. So what's really happening, I am sitting at 6,000, so I'm like $21,000 behind. The margin is right where I guessed it would be, not where I wanted it to be percent-wise. I want it to be about 75% of my equity. So in other words, $65,000 of margin is what I expected to have, compared to 87,000 in actual equity. So in reality, I got 67,000 in margin, but only 66,000 in equity. And for those of you scratching your head wondering about, I'm gonna get a margin call, my equity can drop all the way down to about 30,000 before they start asking me for some more money. But I have self-imposed limits where I'm not gonna get that far or that close. So the stock market would have to drop like 60% for that to happen. And in the history of the stock market, it's never done that. And hopefully it doesn't happen during my lifetime. So anyhow, for the gain this week, we're down 3%. And this is all about comparing the rental house to the ETF. And this is how the rental property would be going, probably $700 a month in rent, 80 in insurance, 200 in taxes. I'd be sitting about $2,900 cash in my checking account. So I figured the house would grow in equity, so it'd be worth like 71,636 right now. I'm figuring 4% per year, which comes up to be $233 per month. So the cash equity, the house would be about 74,000. And if you want to compare those two, the house is here 74,000. ETF's about 66,000, so the house is up 8,500. Looks like the house is winning, but I don't think the house is going to win long term. I think these ETFs are going to turn around and catch up and leave the house in the dust. So that's a weekly update. Talk to you next week.